Decisions. It's time to solve your dollar dilemma. Sean in Minnesota, what's your dollar D?
Hi, Carmen. Thanks for taking my call. I've been working to do a couple of things with my finances. One is to eliminate my credit card debt and my installment debt.
Good move.
Except for my mortgage, of course. And two is to build up my emergency cash reserve. Now, the last remaining credit card account I'm working on is from some large purchases that I made at Best Buy, and it's one of these promotional 0% interest for up to 24-month accounts, and it's the due date on that is September 2010. It's currently carrying a rather high ratio of outstanding balance to credit limit, and so my question is this: from a credit score standpoint, is it better to A, use my savings to pay this thing off immediately and take the hit on my savings, or to continue to make the regular on-time monthly payments between now and September 2010?
Well, Sean, you bring up two very important points before we answer you here, is that one, these cards are, listen, they have very small credit lines. So when you do spend it, basically you fill the card up.
Right.
And two, watch out. You've got a 0% now, Sean, but they are notorious for changing the terms on the slightest drop of a dime. So, Tim, what do you think you should do?
Sean, I've got no fewer than 7 reasons why you should have never done that, and you should pay it off right now. But what I want you to do instead is just repeat after me. You ready?
Yep.
Okay, you say, Tim, I pledge that I will never again buy toys with a line of credit. Go ahead, Sean.
I will never again buy toys with a line of credit.
Oh, yeah.
Fantastic. Everything's better then. You're in great shape.
That's a brave man, Sean. Brave man. Yeah, I mean, the key here is understanding that, Sean, that you may take that credit hit. Do you have ample emergency savings, though?
I do.
You do, ample. So you got at least 6 months of savings.
Well, that's what I'm working to build up.
Oh, okay. Here's what I would do. I wouldn't take the savings. I would transfer this onto another card.
Is the pledge off now?
The pledge is just gone. This is old news here. Sean, you've got this money. I want you to put it on another card because even though you got that 0%, the danger here is your credit score is taking a hit, and they can change the terms at any point. And Sean, here's the thing. The interest rate that you're going to get is going to be retroactive. Check your fine print. On these store cards, 29% can be retroactive. I'd hate for you to get burned by that.
If you don't pay off the balance by the due date, right?
No, if you, for example, if your payment is not received within the minute of the due date, they can make you retroactively pay 29% interest.
Okay.
Read that fine print, Sean.
And they've got a little clock there. It actually times to the minute.
Dangerous. Just leave that one alone, clear it off, put it on another card. You're in good shape. Don't spend your savings. William in Louisiana, what's your dollar D?
Yes. Hi, Carmen. I have a mortgage note, $200,000 note that I receive income on. It's interest only. It's a 6% APR. I'm thinking about, it's got 25 years left on the note. I'm thinking about selling the note at a discount in order to buy real estate property for investment for income. I was wondering if that's a good idea or not.
Well, William, you share this note, right?
Yes, I do.
You do, but the 6% is yours.
Is my
Doug,
percentage.
what do you think? Is it worth him getting out and doing something different?
Well, let's keep it simple. What I look at is you're basically saying I have a $200,000 asset-backed security that's paying me a 6% coupon, and I'd like to replace it. So, you know, the short answer is that sounds pretty good. And it would have to be the 6%, and it's backed with that asset that if they default, you would get that asset back, and you could redo this. So the deal you'd be replacing with has to be substantially better, both in what you'd receive and net of all these transaction charges to get out of the loan you're in, to get into the new property, and maybe appreciation down the road might be better, but it has to be substantially better. Or what's wrong with 6% in an asset-backed income right now?
I mean, that's what I'm wondering. Tim, what do you think?
William, you're likely to sell this at a discount. I think you've already mentioned that right now. Similar investments are probably paying more in the realm of 8 to 10%. So if you can find a private buyer who's willing to accept the 6% and do it for the price you want, then it makes sense. Otherwise, keep it simple, like Doug said, and take the interest.
Yeah, William, I'm kind of liking your odds of sticking with what you got at that 6% rather than going out on your own, basically, and trying to replicate that or do even better. So, you know.
One last thing. Talk to your other partners and see if they're willing to just buy you out for a number that's higher, because there's typically, if it's a family thing, not as many transaction charges if you do it that way.
Yeah, we want to avoid those fees. Thank you so much, William. Now, Tiffany wrote us on Facebook and asked, my husband and I save 10% of our pay each week to invest, since we have to wait a year before we qualify to participate in our company's 401k plan. Good move. Recently, our employer suspended the company match. Should we participate even though there isn't a match, or should we invest somewhere else? We get this question a lot, Tim.
There are benefits beyond simply the match. You do get the tax deferral. It's going to reduce your taxable income each year. If that's something that you're used to, you may not necessarily be inclined to give it away. But I do think that what you can do at this stage of the game is take a look at the Roth IRA. You know I say this every single time I'm on the show, but this is another one of these situations where it works. Use the Roth first, and then go to get the tax break with the 401k.
Doug?
Yeah. Do we want to do the Roth dance? No.
Roth dance.
It's Roth.
Is there a Roth dance?
There's a Roth dance.
There it is.
Listen,
like
Tiffany, we love the Roth so much. I really wanted Doug to dance that one out, because you just can't lose with this one.
There's two buckets of money. One that's tax deferred that you're going to have to pay taxes on down the road, and one bucket of money that's completely tax-free that you'll never pay taxes on. If you can forego the little break now, that huge benefit down the road is so much better. And if the company's not giving you any free money, you're not missing out on anything other than that small tax break right now. So that's why the Roth wins in this kind of scenario.
All right, Tiffany, you saw it. We danced for you. Come on. Mary in New York emailed us and asked, I was thinking about buying TIPS, T-I-P-S, with my IRA, but I'm worried about all the talk about a treasury bubble. Should I buy the TIPS? Tim, I'm not a big fan of that.
I'm not a big fan of TIPS for multiple reasons. Now, forget that there is a bubble for a second, because there is. That's coming. But the other thing about TIPS is this. The entity who's determining the interest is the same entity who's paying the interest. I just don't like my odds on this. The government's not exactly handling everything these days in the financial realm perfectly, so I'm not going to trust them.
But, you know, I'm actually curious here. I mean, Doug, have you seen IRAs that actually offer TIPS within them?
Sure. There's tip mutual funds, and I would disagree a little bit. I think that TIPS as a part of a diversified fixed income portfolio can have a place, especially if you're of the inclination that inflation's going to kick up. And there are a lot of people who really believe that it is. Yeah. If it doesn't, then the TIPS would lose relative to other things. And the bubble you see in treasuries isn't necessarily a bubble in TIPS. It's in straightforward treasuries. So I like it as part of a bigger picture. I wouldn't put all my money in TIPS.
A little bit. Thank you for writing, Mary. Next week, a special hour-long edition of Dollar Dilemmas. We want to hear from you. Send us your questions on investing, debt, savings, mortgages, anything and everything, money, and more. Email me at carmen@cnbc.com. Call or text, and you could be on the show. We'll be right back after this.